Employee Ownership Trusts, or EOTs, are a relatively recent concept in the UK, but they have quickly become popular. An EOT owns a controlling interest in a company. The trust is set up for the benefit of all employees, and the shares in the company are held by the trust on behalf of the employees. EOT is a form of employee ownership, which means that the employees of the company have a significant ownership stake in the company. EOT ownership is often seen as a way to improve employee morale and productivity, as well as to create a more sustainable business model. So, is an EOT the right choice for your business? To help understand this, here are the main pros and cons of an employee ownership trust. Firstly, here are the main benefits for employees. EOTs can provide a real sense of ownership and pride in their work, as well as a financial stake in the success of the company. Employees can be directly rewarded for the hard work with annual tax-free bonuses of up to £3,600 where the qualifying criteria are met. EOTs can also help to improve employee retention and attract the best new talent. EOTs are often more resilient in economic downturns than other types of business structures. This is because employees are more likely to stay with the company through tough times. They are more likely to work hard to make the company successful. There are also significant benefits for the exiting shareholders who are selling their business to the EOT. When selling your controlling stake to an EOT, you are guaranteed the full market value for your shares, subject to independent valuation. Unlike a trade sale, you can also gain certainty of an exit in a clear, defined and relatively short time frame, meaning the whims of trade buyers cannot impact or delay the sale. You can also exit the business with assurances that your employees are being looked after and their jobs are safeguarded following the transaction. Finally, if the right conditions are met, the seller will benefit from a reduced rate of capital gains tax. As announced in the 2025 autumn budget, the rate of capital gains tax arising on the sale of shares to an EOT will be taxed at 12%, half the main rate of CGT of 24%. Whilst this represents an increase in the previous rate of CGT applicable, an EOT often remains the most tax-efficient exit option with many other positive aspects, rewarding employees, preserving business legacy, and ensuring certainty of exit. With significant benefits, it is perhaps not surprising that EOTs are so popular. However, it may not be the right choice for every business. There are some important considerations and potential drawbacks that must also be considered. Firstly, the value of your shares may be lower than that you can successfully negotiate with a strategic trade buyer. Of course, there's no guarantee this buyer will be out there. Secondly, day one cash is restricted to cash on the company balance sheet, enhanced by funds that can be raised from funders for the transaction. Deferred consideration generally makes up the remainder of the consideration and is paid over several years. In short, a selling shareholder won't receive all the cash for their shares immediately. Finally, an EOT transaction is a relatively complex process requiring significant legal and accounting assistance. Therefore, depending on the business value and size, it may not be appropriate. Whether an EOT is the best route for you and your business depends on specific circumstances surrounding your business and employees. If you are considering an EOT, it's important to do your research and seek professional advice so that you can fully understand the pros and the cons. If you're interested in learning more about how an EOT could work for your business, we encourage you to contact Shorts today. Alternatively, why not read through one of our many guides and resources available for free at shorts.uk.com/EOT.